Good day, ladies and gentlemen. Thank you very much for joining us into today's broadcast. My name is Edward Siweya. Apologies that you can't see me through video because the stream, the network quality on my end is not good. So I'm worried that it's going to freeze from time to time. I hope and trust that I'm audible enough for you to be able to hear me. And accordingly, you will be able to follow the intended objective of this workshop. I fully appreciate the time that you took to join us into today's workshop. The workshop theme is called the Opportunity Cost Conundrum. Do I retire or do I resign workshop? So with that said, I also wish to mention that this is part 3 of a 4-part series. Part 1, we ran it on Monday. Part 2, we ran it yesterday, which was Tuesday. And today it's Wednesday, where we are indeed running part. Tomorrow is Thursday, and we are going to conclude a 4-part series by it running part 4. Let me hasten to mention that part 1 was indeed dealing with the question of retire with GEPF. Part 2 was also retire with GPF, but primarily looking at the analysis, wherein ultimately we wanted to ensure that we dissect the benefit statement, especially for a member who says, I am retiring with GEPF. So we undertook under part 2 the analysis of the GEPF benefit statement. Today, the strategic objective is to run a part 3, which is what if you resign from GPF? What will happen or what is likely to happen? So accordingly, I hope and believe that you are going to benefit from this workshop and you are going to derive maximum value. And indeed, this will assist you in making an informed decision. Today's workshop is called Resign and Transfer Option, because when you resign, there are various options that exist or are at your disposal. So today's workshop is Resign and Transfer Option. So that's what we are going to deal with. Tomorrow, under part 4, we are going to focus our attention on resign and cash. And also, as a last resort, we are going to engage in the process of analyzing part 1 and 2, bringing it together with part 3 and 4 as a conclusion. That we're going to do tomorrow when we run part 4. And just some housekeeping issues, ladies and gentlemen. It's very critical to mention that this presentation, together with the presenter, we are not associated with GEPF, either as employees or directly or indirectly as a representative of GEPF in any way or form. And the content of this What If You Retire with GPF workshop was derived from the practical and applicable documents available at our disposals, which one is GEP law, Pension Fund Act, the Tax Administration Act, GEPF annual reports, and also the actuarial report, which was produced in 2021. And I further wish to mention that This content does not seek to purport or to represent financial advice. Is for information purposes only, not intended to be eyes. So you are going to gain value from this part 3 of 4 part series. The target audience of this workshop is aimed specifically at any GEPF member who is currently of age 54 and above. So we are aiming at anyone 54 because the minimum retirement age as per Pension Fund Act is age 55. Therefore, if you are 54 years of age, you are just, your 1 foot is just indeed near age 55. So we believe that you are indeed relevant audience up to the age 64, 11 months. So once you hit 65, by default, you can't exercise a choice because ordinarily you will have to retire with GPF. So we are looking at anyone from 54 up to 64 years and 11 months. Let's deal with the definitions because remember the workshop content, it's the theme is the opportunity cost conundrum. Do I retire or do I resign? For the past 2 days, part 1 and part 2, we dealt extensively with the retire question. So today and tomorrow, we are going to focus our attention on the resign option. So what is this opportunity cost? By definition, opportunity cost can be defined as the value of the best alternative forgone. You are sitting here with option A and option B. Banana on the left, apple on the right, and each cost R1. And you've got only R1 in the pocket. What are you going to buy? Are you buying banana or are you buying apple? So when you buy apple, it means you have exhausted the R1 that you had on your pocket. Effectively, it means you can't buy banana. So you've exercised an opportunity cost, meaning by foregoing banana in favor of the apple, banana becomes an opportunity cost. And equally, when you buy a banana instead of an apple, because you only have got R1 and both cost R1 each, then it means you have exercised opportunity cost because you've forgone apple in favor of banana. So the opportunity cost definition is the value of the best alternative forgone. Equally with GPF, where it's either you retire or you resign. When you retire, the best alternative forgone, it's resignation. And when you resign, the best alternative forgone is retirement. So right now we are dealing with choice B because Monday and Tuesday, we're dealing with choice A. Choice A represent retirement, and today and tomorrow we are going to deal with choice B, which represent resignation. I hope I've done justice in relation to outlining what an opportunity cost is. Let's go in and define conundrum. By definition, conundrum is defined as the most confusing and difficult problem or question. Obviously, if most confusing, and so therefore, hence we are calling it the opportunity cost conundrum. I hope I've shed light in terms of what we've done, the theme, the way it is. Let's get into the background. GEPF as a fund, as at last annual report, which was produced as at 31st March 2022, GEPF, the total fund size was 2.3 trillion rand. That's how big GEPF was as at last financial report. Just for your interest and historical trend, we are talking resign or what if you resign from GPF, because statistically, members of GPF do not only retire, they are members who resign. And through this slide, you can see that from 2016, 2017 up to 2022, 2021, sorry, 2020, 2021 financial year, members have been resigning as much as they've been retiring. So if we look into 2022, 2020 to 2021 financial year, 16,055 members resigned as compared to 29,960 who retired. So if that is the case, then this is a compelling case to justify why we have to run the workshop. As at financial year 2021-2022, which is 1 April 2021 up to 31 March 2022, 83.8 billion rand was paid out as a result of resignation. And this represents 20,659 members who resigned. So therefore, this becomes the justification and the rationale why this workshop is critical for us to have it. Let's get into the gist of the workshop. There is only one door to enter GEPF, but 4 doors to exit. The door to enter is called employment or condition of employment. So your condition of employment will stipulate that as part and parcel of your employment, you must join GPF. That's the condition of employment. But to exit GPF, you've got only 4 doors at your disposal: death in service, ill health in service, retirement, and retirement can refer to early or normal retirement or resignation. However, out of the 4 doors, 2 doors are involuntary, meaning that you don't choose what to do or what to happen, what must happen to it. 2 doors are voluntary. So what does that mean? It means out of the involuntary exit, death and ill health is not a choice that a member makes. It's a cause of nature. Therefore, we'll not spend time and discuss that. Where we're going to spend time and engage you, it is on the voluntary exit. That is where the opportunity cost comes in, and that's where the conundrum comes in. Today, we are going to focus our attention on resignation, but specifically on resign and transfer. When you are faced with an exit option, either to retire or to resign, the primary decision is that you've got 2 options. Option 1, do I retire? Or option 2, do I resign? We've dealt extensively with option 1 for the past 2 days, on Monday and yesterday. Today, we are going to focus our attention on do I resign option. Many members make a fundamental error on this one. When members have made a decision to implement option 2 of I want to resign, they think they're done with the decision. But no, ladies and gentlemen, you are not done. Once you say I want to resign, there is a secondary decision that you must make. And such a secondary decision requires you to ask, do I resign and transfer my money into an externally approved retirement fund, which in its own affair you are deciding to retire? Or do I resign and cash, which in its own affair you are deciding to cash or to withdraw from the pension money? Today, we are going to focus our attention on I want to resign and transfer my benefits. So today's workshop, part 3 of the 4-part workshop, will focus on I want to resign, but I don't want to cash. I want to transfer. Then the question is, what will happen if I resign and transfer, and what is the process? Many members normally shy away from this decision, secondary decision. Normally what they'll do, they will simply say, I want to resign, which is step 1 or primary decision. They will write a resignation letter And then upon writing resignation letter, they will give it to their HR. And upon giving their HR the resignation letter, then they will go and sit at home until they are called to complete exit paperwork. That is the most dangerous process you can ever take, because once you say you resign, you are not done. You must make a secondary decision to say, how do you resign? And part 3 will engage that subject. Who qualifies to resign and transfer? That is someone who says, I am of retirement age. However, I am not suitable to cash because I want to retire. But as I want to retire, I do not want to cash my money. Therefore, I want to retire, but I don't want to retire with GPF. I want my money to be transferred to an externally approved retirement fund. So that is the best alternative as well to retiring with GPF. Then you want to retire privately by converting your money from GPF as a defined benefit fund into a pension fund act, a provision which is governed by the Pension Fund Act. Now, let's get into the gist of the conversation. By opting to resign and transfer, you are effectively transferring your actuarial interest, or what is called the resignation value, into an approved retirement fund. So let's see how that works out. Once you issue the employer with a resignation letter, the employer is going to call you, and when I say employer, I'm talking termination office or HR. They are going to call you so that you are able to complete a choice form. Choice form is completed upon a member who has resigned, and such a member must make a choice whether they under this environment B. Then once you choose option B, then you must also complete an external transfer to an approved fund, Z1525 form, wherein you need to indicate where the money needs to transfer. The most important part here, ladies and gentlemen, is that this money is not going to be transferred into your bank account. This money, 100% of it, will be transferred to an external receiving fund. And accordingly, such a receiving fund will receive 100%. So it's a fund-to-fund transfer. You will come in later and we'll show you where and how you come in. Let me kindly start the process by taking you through a benefit statement. The benefit statement that we have in front of us is showing us, especially the last part, is called the resignation benefit under item 18. Resignation benefit says that this member that we are looking at is having 4,490,706 into their fund at GPF. That amount that is called the resignation benefit, it is actually an actual interest that represent the value that the member has at GEPF. Remember, I mentioned earlier that GEPF is worth 2.3 trillion rand. Then each member within GEPF, which is 1,261,000 plus minus members, each member has got a value attached to them within the GEPF system. That is why resignation benefit is actually the value in the fund, or the actual interest, which is 4,490,706. This 4,490,000 does not mean that when you retire, you are going to get it in the bank account. No, that's not what it means. Or when you resign, that is how much will be paid to you. No, that's not what it means. What that means effectively is that that is the value in the fund. And if you retire, if you resign, either you cash or transfer, that amount must be subjected to tax processes and other related processes. So let me take you through the illustrated process. When you resign and transfer, GEPF is going to receive one, the with choice form, which has been ticked under option B, as shown earlier, and also the Z1525. Once they receive those two documents, then GPF knows that you have chosen to transfer to an externally approved retirement fund. So what they are going to do is that, since you saw the member there has got 4,490,706, that value is going to be transferred to an approved external retirement fund. Who is this? The fund, for it to be approved, it must be approved by the South African Revenue Services, SARS, as well as it must be approved by Financial Sector Conduct Authority for it to be recognized as an approved fund. Then the full 100% will be transferred, zero tax, zero penalty. Then once the 4,490,000 lands within the externally approved external retirement fund, then that is when your payments will kick in. And the payments will be as per advisement between you and your advisor, so that at least as per agreement, if you agree that you're going to get X amount of money, before that money is paid to you, because here you can't get 100%, you must get at least part of the money, and part of the money must be used to ensure that you receive a monthly compulsory income. Therefore, under that environment, it's clear, ladies and gentlemen, that you have chosen to retire. Don't choose to transfer while your interest was to cash. Here you are saying, I want to retire, but I don't want to retire through GPF. I know the conditions of GPF, and certainly my balance sheet, which is liabilities vis-a-vis assets, your liabilities are more than what GPF give in terms of gratuity. Then you say, no, I need more money, because I know that I will be able to pay off my debts if I were to resign and transfer, which is a retirement option. Or maybe the motivation might be that, okay, I don't have a spouse as at age 60, age 64, age 55. Therefore, I want to transfer so that the bulk or the portion that is left after I've been paid a lump sum I must have the authority and right to nominate beneficiaries. Then when the lump sums that you're going to be paid, before the money comes into a bank account, they will be shown SARS, and SARS will issue a tax directive to the approved external retirement fund and say, you approved external retirement fund, since you, out of 10 rand, you want to give your member 3 rand, I hereby request that out of the 3 rand, you pay me 20 cents or you don't pay me anything. Then after SARS has said 20 cents out of 3 rand, then 20 cents will pay to SARS and the balance will be paid to you. What is left after you've received your lump sums, then that will be used to ensure that you earn a monthly pension up until the day that God decides to call you through death, and thereafter, then the balance of what is left in the investment account will pay to your beneficiaries. So this is just the theory. We're going to get to practice shortly. And here we are now on the case study. Let us indeed get into the gist of the presentation by getting into the case study. With the case study, ladies and gentlemen, we aim to show you practically how does the lump sum get determined. However, we shied away from showing you the monthly income because that is a product of agreement between you and the advisor. We did not want to tap into that space because it's an advised decision. However, the lump sums, we can show you in terms of the range, how much minimum you can expect and how much maximum you can expect. And then from there, in between that, it's a conversation between you and the advisor, meaning that the upper amount, the advisor can never give you more than that, and the lower amount, the advisor can never give you more than that. So we're just only going to show you that so that you are able to comprehend what is happening. We further wish to bring an important disclaimer, and that disclaimer says that the outcome of the benefit statement case study analysis was conducted by, and it was a courtesy of Net Wealth Analytics. Net Wealth Analytics is an authorized financial service provider which has been authorized by the Financial Sector Conduct Authority, and it has been given a mandate to make recommendations on behalf of what they see in front of them in relation to benefit statements or any other recommendation that needs their attention. So this following slides and analysis outcome, it's courtesy of the Net Wealth Analytics Group. Of interest on this benefit statement, maybe what I can do here to highlight is that this benefit statement was issued on the 17th of March 2023, and it is dated estimated exit date 31 December 2023. So it is a recent benefit statement. The member's date of birth is 30 October 1967. So already we can deduce that by 31 December 2023, the member is 56 years and 2 months. So this member then has entered the minimum retirement age of 55. So what that means is that this member indeed qualifies to actually resign and transfer, by virtue of the fact that by resigning and transferring, this member will immediately be able to earn a monthly income. I must also hasten to say that even if you are not 55 years of age currently, you might be 30, 40, 45, 35, whatever age you are. When you resign, ladies and gentlemen, you are eligible to resign and transfer. However, because you are only below the age of 55, you can't earn a monthly income until you are 55, meaning that within that age, before age 55, what can only happen is that you can only transfer 100% of your fund credit, and thereafter, what is going to happen is that you will be paid part of the lump sum, and part of it will remain up until such time that you are 55. This is a proposal for those who wants to indeed impact positively their income replacement ratios. So that is all that we just wanted to bring to the fore. But in this case that we are busy analyzing, this member is 56 years and 2 months as at 31 December 2023. So therefore, this member has entered the retirement age, and we can confirm that indeed they do qualify for retirement, and we will discuss retirement accordingly. The resignation benefit that we are looking at, ladies and gentlemen, is 4,490,706. Other numbers and other details are unimportant. They are not important on this aspect. Only the resignation benefit is the one that we are going to focus on, because the member is resigning and transferring. So what is this member transferring? The member is transferring the 4,490,706. So they are exiting GEPF in favor of private pension. Now, let us kindly conduct the analysis. Firstly, you would have seen that this member started working on the 1st of January 1996. There is a rule that from 1 March, anyone that started working before 1 March 1998, the period of that employment is tax-free. And the period after 1 March 1998 vested right is taxable. So what that means effectively is that if you started working 1990, on the 1st of January, it means from 1990, 1st January to 1998, 1 March, that period is tax-free. It's 8 years. But any period from 1 March 1998 up to 31 December 2023 or any other date, that period is taxable. So in this instance, the total service period for member is 27 years. 2 years are tax-free and 25 years are taxable. So that is a very important context, because that 2 years is going to benefit the member favorably. And then you will see it in the next analysis when we get to it. Just to recap again, the GEPF resignation benefit value is 4,490,706 as at 31 December 2023. Of importance here, this 4,490,703, it is as at 31 December 2023. It is not when the member is 60 years, no. And there is no penalty on this 4,490. This 4,490,703.6, that is the value that will be transferred to the externally approved retirement fund. So there won't be penalty that will apply on this 4,490. It's very important to bring that point forward. The second point now relates to the 2 years from 1996 to 1998. Those 2 years, 2 over 27, are tax-free. Let me get a calculator so that we can work it out. I've got a calculator, ladies and gentlemen. The 2 years, so we can say 2 over 27, that is equal to 7.41%. So 7.41% of 4,490,706 equals 332,645. So meaning 332,645 of this member's benefits is tax-free. But if we go below, again, this member, because of he or she is above the age of 55, anyone who is 55 and above, by default, SARS has created an environment where they get 550,000 tax-free, provided you retire. This 550,000 does not apply when you resign. Even if when you are 60, when you are 64, you don't get 550,000 when you resign and cash. Only when you resign and transfer. Then, because that is a retirement decision, then 550,000 kicks in. Therefore, in total, this member is having 882,645 as the total tax-free portion. So whatever we do, 882,645 is not taxed. The balance will be taxed. This point is very important, ladies and gentlemen, very critical. And I think it's critical that I re-emphasize it. This member started working 1 January 1996. As expected resignation date is 31 December 2023. It means 2 years is tax-free and 25 years is taxable. 2 over 27, which is 2 plus 5, 25 is 20 total years from 1996 to 31 December 2023 is 27 years. So 2 over 27 years, then it becomes 7.41%, which equates to 332,645. Then when we bring in 550,000, which previously we used to know it as 500,000, the Minister of Finance has boosted this much to adjust it to indeed the pension, and they provided at least 10%, and they made it 550,000, which is tax-free, plus the pre-1 March 1998 exemption. Total tax-free amount for this member is 882,645. I must mention that this tax-free portion is different depending on your member profile. So it is not standard across all of you. We need to analyze your benefits and understand exactly where do you fall within this assessment. Then this member says, okay, Edward, I know that I've got 4,490,706. I don't want a cent from it. Kindly use this money to buy me pension, meaning monthly compulsory income. Then you see on the right, through the same technique of tax-free analysis, 882,645, meaning that this member actually can take 882,645 tax-free, but he or she said, I don't want a cent. Kindly use 100% of this money to purchase me pension. It's possible. You can make that decision. Then it means there won't be tax, there won't be money in the bank account. The only thing that will kick in is that 4,490,706 will become used to purchase pension, and monthly pension therefore will be worked out. And we exclusively did not show these amounts intentionally so that we don't influence you in any way. But the gratuity part is very important, meaning it's 0-0. What is gratuity to fund credit? It's how much the member gets over fund value of 4,490,000. And the consumer price index, as at January, thereabout, it was 6.9. But today, the CPI was, numbers were released, and it moved up to 7.1%. So we are now talking 7.1%, but at the date of producing this data, it was 6.9%. Then this member says, okay, let's move away from zero money in the bank. Kindly pay me tax-free. Then if the member says we must pay them lump sum of tax-free, it means we are giving them 882,645 because that is the tax-free portion. Then it means no tax is payable on the same principle as zero tax, because we know on the right already that the total tax-free portion it's 882,645. So therefore, if on the right that is the total tax-free, then on the left we are taking the same total tax-free and paying it to the member, then it won't attract tax because we are paying the member lump sum that does not attract tax at all. Then from that decision, the member is withdrawing 19.7%, meaning the total tax-free portion equates to 19.7% of total 4,490,706. That is 19.7%. That is why you see that indeed this member will not actually be paying tax. And the balance of 3,608,061 will be used to indeed structure monthly pension. Again, this member says, Edward, open the tab a bit. This option, ladies and gentlemen, is flexible. It depends on the advice and the need. How much do you need to close off the gap? Because what we don't want is a member who retires and end up with debts while they are on retirement. We don't want that. So the liability side of the member's balance sheet dictates that open the tab, give me more money because I want to take care of liabilities and settle few things and adjust few things in my life. Then this member is paid 33.33%. That is 1/3. 1/3 equals 1,496,902. Now, this money pays tax because tax-free on the right, it's 882,645. So if that is the tax-free, by default, the 1,496,000 is greater than the tax-free. It means if we move to the left, then 614,257, which is taxable portion on all lump sums, is what will attract tax. And the tax amount equals to 146,882. If that is the tax, it means we must deduct 146,882 off 1,496,902, and net payable into the member bank account, it's 1,350,020 rand. So that's what that means, meaning that 1/3 exceeds tax-free. And when it exceeds tax-free, then it will the difference between tax-free and 1/3 will attract tax. And when it attracts tax, then tax will be 146,882. And through that, then we know that no, we are indeed, the member will get 1,350,020 rand. Therefore, the balance, obviously, because we are paying more now, the TEP is being released. Then the balance of 2,993,804 will be used to design monthly pension or annuity for the member. Now, this member says, Edward, open the TEP because the financial need is greater. What is the maximum that this member can get? Similarly, on the right, the same tax-free portion is still the same. But once you move to the left, then the maximum that this member can get is 2,494,837. Then, obviously, out of 2,494,837, only 882,645 is tax-free. Then it means 1,612,192 become taxable. Remember, this 2,494,000 has been paid in two parts. It has not been paid once off. It has been paid in two parts, and jointly it become 2,494,000. Inside these 2,494,000, there are advised secrets, which we will not dwell into. But there are, I need to give caution to say 2,494,000, inside it, there are advised secrets. So we are not going to reveal the advised secrets because that it's a comparative advantage of net wealth analytics, but that is how much this member can get of 4,490,706. And out of 2,494,837, this member will pay plus minus 211,708 in taxes, and a balance of 2,283,129 they will get into the bank account. If they are paid that much, then it means less is remaining to purchase pension because more has been paid to the member. And on that basis, it means this member has been paid 55.6% of fund value, which is 4,490,706. So that now what I was talking to, the minimum, the maximum lump sum which the member can get. The minimum is 0, and we can play in between that 0 up to maximum of 55.6%. So why should you resign in cash if indeed you are eligible to get 55.6% lump sum for which you can use to take care of your obligations, and the balance of 100% minus 55.6, which is 44.4%, can actually go and purchase you a monthly pension. So why would you want to sacrifice this benefit in favor of higher taxes, which we'll demonstrate tomorrow when we are dealing with part 4 of this presentation? So this is what it means. This member would have been paid 55.6% of lump sum, and only 44.4%, which is 1,995,869, is remaining to buy the member monthly pension. Now, with that said, what is the analysis conclusion? 1, the ideal option, or this option is ideal if your benefits or your debts exceed the GPF gratuity lump sum amount. What is that supposed to mean? It means on the basis of the same GPF analysis of the same benefit statement, the member was going to end with almost 1,064,000. But your debts collectively, they make 1.5 million, 1.6 million. So it means if you go with GPF, you are going to suffer the consequence of not having sufficient money to take care of your debts. I must also bring to your attention that on this option, you are eligible to withdraw a lump sum amount of 0% up to 55.6% of fund credit. And we've already demonstrated to you how. And thirdly, the more lump sum you withdraw, then the less will remain for income purposes. That point must be made clear. That the more lump sum you withdraw into the bank account, then the less remain for income purposes. That point is critical. Another aspect that we must bring into the fore is that when you have withdrawn retirement annuities previously when you turn 55, those retirement annuities, when retirement tax benefits or tax directive is sought, now after the transfer, that amount of retirement annuity that you received maybe when you turned 55 will come in and have an impact in relation to how much tax you are going. So that tax analysis that I've shown you assumes that you have not yet received the retirement annuities before. If you have received retirement annuities before, that size of the retirement annuity is going to have a negative impact, and you are going to be taxed more than what meet the eye, because taxman operates on a cumulative basis principle rather than on an isolated principle. This point is very critical, and indeed, for you to understand it better, kindly take notes. We are going to have a Q&A session on the 27th of April, which is next week, at 1800 hours. So I would like you to jot down the notes of what you wish to ask at any part of the part 4 parts workshop, and then we'll deal with that issue accordingly. Where you are likely to access these transfer houses are these companies, and it's not limited to them. There are plenty of them where you can indeed access the externally approved retirement fund, either in the form of a retirement annuity or in the form of a pension preservation fund. You can't transfer GEPF money as a pension fund into a provident preservation fund. You must transfer into a pension preservation fund or a living or a retirement annuity. Life annuity, that is GPF structure typically. And how it works is that you trade off lump sum in favor of monthly guaranteed income for life. And in there, you can have a term, which is 5 years, 10 years, 15 years, 20 years, or you can equally peg that against life cover, so that if you die, then life cover will kick in and pay beneficiaries. Living annuity. What is a living annuity by definition? A living annuity, it's capital value used to purchase the pension, or let me repeat this one. The capital value used to purchase the pension is invested in an investment account. Then from this account, pension can be withdrawn either monthly, annually, or semi-annually. So it's flexible. The amount of pension can vary between 2.5% of fund value up to maximum 17.5% of fund value or capital value. And this amount can be changed from year to year on the anniversary date of pension. The investment account invests in unit trusts, managed funds, share portfolio, etc., money markets. And the annuitant, which is you bear 100% of the indeed investment risk. This is just an illustration. You remember I was showing you the lump sums previously where you can use them to purchase monthly income. Then those lump sums, it means that consequently, you open an investment account or a savings account. On the left is what you are paid as an income. It's negative. It is drawn from the savings account. And on the right is the investment return generated by that money being invested to generate savings or interest. The principle is the investment return must exceed the monthly withdrawal income, because once the monthly withdrawal income exceeds the investment return, then you deplete the savings account. However, what is certain is the withdrawal percentage, which is a liability, but we can't determine the investment return until is the end of the year, where we'll have checked what did we do from the start to the end of the year to justify whether we produced enough interest or not to cover what was paid to the member in that financial year. In principle, this is another illustration that I normally would like to use. If your investment represents a Jojo tank, On one end, on the right, is the prudent collection of water in the JoJo tank. The prudent collection of water, the more judicious you are in how you collect water, you don't misuse water and the likes, the better water will sustain you in the JoJo tank. But on the left, the more you open the tap aggressively, the more you utilize the water in the tank. And the investment growth, sometimes there is drought, sometimes it rains, sometimes there is no rain at all. So the investment growth represents the uneven collection of water into the JoJo tank. So you need to make sure that you are judicious and you are prudent in how you collect water through the right, so that you are not like the member who was open the tap a lot as if it's guaranteed that it will rain or water will flow into the JoJo tank. So that's what it simply means. I'm using the JoJo tank as an example. I can use cows in this example. When you've got 10 cows, on the left, you are eating your own cows. Simple. On the right, you are waiting for the cows to have calves, and then you're going to receive milk. And then as the calves grow and become fully fledged cows, then you slaughter from there. So you are judicious in how you are managing your wealth ultimately. So the more you are on the left and you are drawing a higher percentage, the more you are finishing off your investment, and you find that you are told your money is finished. But the more you are calculating and taking good care of the money, the more it sustains you and it looks after you into the future. Another option is that you can have a hybrid structure where part of the money is invested in the living annuity and part of the money is invested in the life annuity, and that is blended approach. So that part of the money, you know that you're going to receive open-ended security of tenure where income will be defined for life, and on another part, you'll take the money invested in the living annuity into the markets. So that's what the blended approach means. This is the client relationship ecosystem. You are the client, you are at the center of all the parties, especially within the living annuity space. Financial advisor is sitting there, you are interacting with a financial advisor, retirement benefit counselor, and then you choose where the money is supposed to go. That's an approved retirement fund. It's called investment administrators or linked investment platforms. And then the advisor recommends who should be the asset manager to grow the assets. Once you expose part or all of your money into the living annuity, there will be cost consideration, which will be attracted by virtue of having exposed part or all of your money into the living annuity. Part of the cost is administrator platform costs. When you approach the likes of Allen Gray, All Mutual, Sanlam, and the likes, Investex, and the likes. Fund manager cost, you remember I mentioned that there is money managers. That is what I'm talking about when I talk fund manager. When I talk platform administrator, I'm talking the investment administrator on the far right of this slide. And also ongoing service by the financial advisor. They have to charge that because they must service you going forward so that you keep on receiving quality and you are not neglected. So these three will attract fees, and ultimately they are combined into what is called total expense ratio. Please make sure that you are close to that process and you understand what that effectively means as an end result. That is just the tax calculation. This is the method to calculate the vested right. I've shown you practically. Then the question is, should I resign and transfer or not, Edward? My answer to that is that I can't give you a practical answer now, except to encourage you to enroll yourself into a retirement benefit counseling process. And that process follows a 4-step process. This part 3 of the workshop is aimed at educating you. Once you are done with step one, which is education, then you are going to enroll yourself into the retirement benefit counseling process or program, wherein this process seeks to make sure that theoretically you understand the concepts. Two, a retirement benefit statement has been analyzed, and three, face-to-face consultation has taken place, up to the fourth, where you've decided whether you want to resign and transfer indeed, or where you want to resign and cash, or where you want to retire. We implore you to engage the retirement benefit counseling process, ladies and gentlemen, because it is independent, unbiased, very much impartial, because it aims to provide you, a retirement fund member, with a comprehensive view of the available exit options needed for a decision when you reach minimum retirement age. It needs to help you understand the available options at your disposal with respect to retirement benefit, and it needs to explain annuities, how they work and how they provide income, and where necessary, link you with the authorized financial service providers accredited to indeed provide advice, who are trained and are qualified to navigate you through the rough seas. And for that, we implore you to call the retirement benefit counseling line 086 001 7402. I repeat, 086 001 7402. And with that, you are going to now enroll formally yourself into the retirement benefit counseling at no cost. You are not going to be charged for this process. And the process seeks to make sure that you are taken through a face-to-face consultation meeting, with the aim of ensuring that you are educated, the benefit statement is analyzed, and you are able to make a decision. Provincial visits are available for face-to-face, but it is on a demand-only basis, meaning that demand only will trigger face-to-face. If Gauteng enroll itself in large numbers, then face-to-face will be triggered for consultation. If Western Cape enroll itself in large numbers, then face-to-face will go to Western Cape. If any of the provinces enroll itself for a face-to-face, then a face-to-face will go for that, meaning that the first step is to enroll yourself into retirement benefit counseling. And then once you are done enrolling yourself, then the next process will be to indeed trigger a face-to-face wherein you will be seen and you will be guided for a fair decision-making. So in conclusion, the program seeks to educate so that you know the theoretical understanding. You've got the theoretical understanding of the process, to analyze the benefit statement so that we can check what will happen if you retire, what will happen if you resign and transfer, what will happen if you resign and cash, and thereafter you decide. Tomorrow, which is the 20th, as an announcement, we are going to now run the last part 4 of the 4-part series, which is going to look into Gepf, resign and cash option. And then after this, then on the 27th, I know it's a holiday, we are going to sit nicely because we know that you'll be at home. And that's where we are going to formally, 1800 hours without presentation, do a Q&A session live on the same platforms. So with that, ladies and gentlemen, we would like to take this opportunity to thank you for having joined us into today's workshop. And we look forward to seeing you tomorrow during the part 4 of the 4-part series. And I hope that you've gained value through this process. Thank you very much, ladies and gentlemen. We fully appreciate the time that you've given us, and we look forward to seeing you tomorrow on Thursday. Thank you very much.